Now, a multinational company's potential transfer pricing issues may include, some important factors here. To start off with, the prices are not usually established in a marketplace. Unless we're talking about intercompany transactions of very much commodity based type product where one can observe the going market price without a problem, prices are often set using relatively simple rules, and these may or may not really reflect the functions that were formed or the risks that are being assumed. Prices are often set according to some sort of corporate profit maximizing goal. So you will see, there may be some internal pressure to get the prices right because business unit performance measurement may be dependent upon the intercompany pricing. You see the management incentive compensation might be also related to that. So these are things that would affect prices within an intercompany situation that would push them towards a competitive number. But there could also be issues that are just involved in supply management and or cash management. Someone may be affecting the prices internally just to move cash from one legal entity to another within the same legal group, same corporate world, simply because they need cash in certain locations. Now, as market forces change, the problem we see within the intercompany world is the prices and the profits may no longer be appropriate. Um, we've even seen structures where people are setting the price so as to minimize the overall corporate tax burden. So there are all these things happening in a multinational company's establishment of prices in their intercompany transactions that are quite different than the competitive forces that drive the marketplace. And we need to keep that in mind. That's our primary goal, is to say we need to establish prices within the company that will meet the standard as though the arm's length standard, which meaning that they are at prices that would have been consistent if the transaction had been with unrelated parties. Now, there's going to be a range of arm's length prices because there's more than one comparable. I say that hopefully. I always worry about analyses that only have one comparable. Remember, this example came from some of our earlier videos when we were talking about our related party is a UK distributor and we observe four other companies that are comparable and we see a range in their results. Here we're measuring it on the operating margin. We wanted to keep the example very simple, so we just used operating margin, didn't worry about what's going on the balance sheet. And we can see that this range of profitability ranges from 2.5% for Delta Company to 8.33 or 8.33% for Charlie Company. So, and what will drive that kind of range? Well, generally speaking, even if we were dealing in a product that was a commodity, so everyone that they're selling to is selling for the exact same price, what we might see are minor variations in profitability that are associated with the fact that one company just might be slightly more efficient than another one. One might have gotten a slightly better deal on a cost of goods sold, or negotiated for, just a few points here or there that are moving its profitability up and down. So now we wanted to look at examples just to sort of give a feel from a real world perspective of what would happen in a marketplace and if you were using an analysis of a controlled distributor. Remember, controlled is essentially the same concept as related party. And that we're looking for that would be our tested party as we've been talking about it thus far. So you have a controlled distributor, and here are their results. They've been having a margin here. I'm assuming these are operating margins, hovering around 2%, drifting slightly above and slightly below. And then we look at the upper band and the lower band, and these are the uncontrolled parties who we've been observing, and they're nicely in the middle of it. Well, this would be a wonderful sort of result to show. You've got a 10-year history here where your tested party is earning profits that are nicely within the range that the market is providing. And it'd be very, very compelling evidence that their intercompany transactions, which in this example we've been talking about as one where it affects the cost of goods sold, are not so off that it's driving their profitability outside of that band. So it's a very positive set of results. Well, to start off with, this is the interquartile range from the lower bound to the upper bound. And you'll notice our tested party, which is this firm right here, going along this line, they're not in that range at all. So that's going to be our first problem that we have here, is that we've got a tested party who is nowhere near the profitability of the other firms that are operating in this market. But there's more here to really worry about. And that is, let's look over here at the scale and not lose track of it. Here's where we're at the zero profitability. Now that's zero accounting profitability. So that's much worse. I mean, it's the economic profits are clearly negative if the accounting profits are negative. And so we have a tested party in this case, if we try to sort of mark it right here, that is below the operating profitability line. I mean, they're having operating losses. Any unrelated party who is in an industry where they have been incurring operating losses for a period of 10 years would be looking to exit the industry. So it'd be very hard to defend that this is a normal behavior of a firm operating at arm's length. Now, the opposite, if this is actually a related party firm, one would look at this kind of a result and ask the question, essentially right down here, the big issue here, is this company using transfer pricing to drive down the profitability in this observed jurisdiction so as to achieve higher profitability in some other jurisdiction, which may be tax advantageous. This may be the high tax jurisdiction. The other jurisdiction is a low tax jurisdiction. And by shifting the consolidated income, by moving more of it into the other jurisdiction, you're getting it into a jurisdiction with a lower tax rate. And that's essentially what we'd be worried about in transfer pricing. Now, this is actually a more common problem that one observes in transfer pricing, and that is you're looking at results that look as follows. Your distributor has been nicely in the range for the last 9 years, and in the last year, you notice that its profits have dropped while the lower bound and the upper bound of your comparable set have continued where they were before, and so you're now below the range. And now you should think about what could be the explanations that could cause this kind of a result. Well, in fact, I'd actually recommend you take a sort of time, take a sheet of paper, start writing down all of the things that could cause a tested party's profitability to suddenly fall. Well, hopefully you've made up a list during that short time. Pause the tape and make a list. Now, we're back to this case, so you can see it quite clearly. You've got a situation in which your tested party's profits have suddenly fallen. And you can ask yourself, well, what are the things that could happen that could make this occur? Well, let's go back to our example that we were working with earlier. Remember we had our example of the UK company who's buying from its Japanese related party, and this is our sort of base case scenario. One possibility that could cause this to happen would be, what if there was a local market impact that caused a decline in demand for the output? If that were the case, we're going to see a change in the UK P&L that's going to reflect that. We're going to see a decline in their profitability. Let's see what would be the example of what would happen to their numbers. So suppose that sales just decline in the UK. Now they're down by 10 from where they were before. Previously they were 100, now they're 90. Assuming that none of the costs have changed in any significant way, they're now suddenly having an operating loss of 5. So, and our consolidated operating profit has dropped from the number it had been previously to now to an operating profit of only 5 because it's down by the change in sales of 10. So this is one possible example, and if you notice here, the transfer price has not changed at all. The transfer price is still the 70, but we have losses on one side of this transaction, and it may just be because maybe the UK has suffered a economic downturn that did not affect the comparables. If the comparables were taken from a pan-European set of comparables, we didn't happen to have any other UK firms in there, but then the UK economy takes a downturn, that could explain this sort of situation. So it's a really worthwhile exercise to go through this and ask questions about what could cause all of these things to happen that could cause the UK to have a negative result, and would that be an explanation? Don't underestimate the possibility that it could be the transfer price. The fact that your profits are low is not necessarily indicative that the transfer price is wrong, but it is one viable explanation and should be explored in your analysis. So a single year being out of the range, does that really mean the transfer pricing is not arm's length? Well, if the transfer price didn't change, it's a decline in sales, like we just shown in that last example, that's probably a good evidence that it's not really the transfer price that's the problem. I mentioned in an earlier video when we were talking about the accounting profits versus economic profits that many countries use multi-year averages to minimize this effect. So instead of asking the question of how is your profit this year relative to the set of comparables this year, often they say, why don't you give me the average profits over the last 3 years, and we'll compare that to the comparables for the last 3 years and see how those match up. But that's not universally true. For example, Canada is one important jurisdiction that tends to focus on a single year result and not multiple years. So one of the questions we need to ask is, if a result is out of the range, why is it out of the range? Are the results truly comparable? Are there other factors such as economic shocks that are affecting our tested party and maybe not affecting our comparables so much? Or, never forget, it could be, does the transfer price really meet the arm's length standard? So going back to this concept of the economic forces that are going to set prices, the other extreme would be to look at really high profitability results that might be coming from a tested party and asking the question, why would they be so profitable? This is a simple bar chart showing very high profits being earned at the manufacturer level, and with the black line representing what we would have expected a normal manufacturer's profits to be. Had this been happening in a competitive environment, other entrepreneurs would look at these incredibly high returns and be asking themselves, can I get into that business? If they could, they would enter that business, they would expand supply, that would drive down price, that would essentially bring the whole market back into equilibrium. But if these results from the controlled manufacturer are only high because of a transfer pricing issue, that's not indicative that the business actually earns economic profits collectively. It could be consistent with the concept of you've chosen to try to earn them in this jurisdiction and probably at the expense of some other jurisdiction that is being underpaid or being overcharged for whatever their contribution to the whole value chain is. So thank you and have a good day.